we always talk with entrepreneurs about is what are you trying to do, right? Like, are you trying to figure out how do I grow without diluting myself, without taking on equity that, I've gotten to the point where I understand my unit economics. I understand my CAC. I understand my LTV. None of those things are really mysterious anymore. So I know if I put $1 into my engine, I'm going to get $3, $4 or out or whatever. Once you have those metrics nailed down, then it makes a lot of sense to take on non-dilutive capital, right? Because there is no risk.
And we're back for another episode of the Startup Hustle. This is your host, Matt Watson. Very excited to be joined by Keith Harrington today, the founder and chief operating officer of Novel Capital, which is based here in Kansas City. It's always awesome to have other Kansas City entrepreneurs on the show. Today we're going to be talking about non-dilutive capital, alternative capital, maybe when should you raise money, what kind of money should you raise, different options out there. If any of you have raised capital before, you know it sucks, but we're going to learn some things today from Keith, give us some pointers, some advice. Before we get started, I do want to remind you today's episode is powered and brought to you by Fullscale, which is my company. If you need to hire software developers, QA, a bunch of different things like that related to software development, check us out at fullscale.io. Whatever it is you need help with, we can help you and save you more than 50% of the cost of building software. Keith, welcome to the show, man.
Thanks very much, Matt. I'm very excited to be here.
Well, we've known each other for a long time. You started this company. It says 2021 on my thing here, but that does not sound right. Isn't this company older than 2021?
Yeah, that's a great question. So we started Novel in its current iteration, which is a fintech platform doing all of our underwriting in an automated way in 2021. Prior to that, my co-founder, Carlos Antequera, and I had actually built a fund using revenue-based financing strategy, which is what we came together to build in the first place. That first fund, I think we ran that from 2018 to about 2020. And based on what we learned there, we started to build Novel Capital.
Well, so I noticed you guys just recently raised a Series A. And so I guess tell us about your company that deploys capital to other people. So you have one set of funds to deploy capital to other people, but then you have a different set of funds for your own growth and sales and marketing and stuff. I guess tell me a little more about that.
Yeah. So, there are a couple of ways to think about companies like us. A lot of entrepreneurs are going to be super familiar with typical funds who are out there. They raise capital from other investors and deploy in whatever form they deploy, whether it's equity or debt or whatever. And that's a very standard sort of approach to funding companies, whether they're early stage or late stage. We decided to go the hard path and raise capital on both sides of the business. So as you said, we raised the money to deploy to other entrepreneurs. But we've raised about 15 million from VCs to continue to grow and scale the work that we're doing. So it's kind of funny when you think about it, like, part of what we do is an alternative or a supplement to equity financing. And you kind of have to hold that truth in your head if you sit in my seat, while also raising capital from VCs, which you're sometimes replacing or supplementing.
Yeah.
So it's kind of an interesting place to be. Sometimes it's an interesting and exciting place to be.
Well, so tell us a little more about exactly the service offering you have and, who your target is. It's other entrepreneurs or startups and kind of what they look like, and then how, the problems you solve, what you provide them.
Yeah. So what we're really doing is trying to solve the big questions that founders have around how do I finance my business, right? Unless you're steeped in venture or debt kind of financing, then it's really hard to understand, when do I raise money? When I raise money, what kind of money should I raise? And in what quantity should I raise that money, right? And these are questions that done wrong can be fatal to a business. So we're super focused on and very passionate about the idea that every founder needs to have the information, the access, and the capital to build the business that they want to build. But that first thing, the information, is really hard to get, right? Because most people are just sort of taught right out of the gate, you got to go raise venture money. That's the only way to fund an early stage business. I don't believe that that's necessarily true. And I think it is probably it is true that there are many ways to start a business and to capitalize it at its earliest stages. So what we do is we look at a company, if they're a fit for us from a non-dilutive standpoint, from a debt standpoint, and we will provide them capital. And typically that's going to look like a 2 to 3 year growth loan. So we'll provide capital. We get paid back over 2 to 3 years. One of the other things that we're providing, though, is for companies that do not fit our credit thesis. We're starting to make intros to venture capital firms around the country. So Carlos and I have a great VC network. We're both Kauffman Fellows. So we've been able to build out a really robust network of VCs who are looking for deals that are great fits for them. So companies that come to us, they share their data, and then based on their actual data, we can connect them to VCs who are more likely than not to move forward with them. Now, maybe they get a financing, maybe they don't, but it's better than a warm intro, which everybody will tell you need, right? To raise venture money. You need a warm intro. We'll actually provide the warm intro and give you access to a VC who invests in companies that look, smell, and sound just like yours. In addition to that, we're also providing tools on our platform to allow CEOs to make those kinds of decisions, like debt makes sense for me now, or equity makes sense for me now, and if so, in what quantity, and how should I think about that?
So what led you to create those tools and do this? You look at it as more of a lead generator, go-to-market, part of your go-to-market strategy? Because to me, it's really brilliant.
Yeah. Initially we started really focused on providing the capital, right? And frankly, we've gotten really good at that. That's our bread and butter. We do it every day, day in and day out, and we do it a lot. What we started to notice, though, was every CEO we talked to had the same questions, like, is debt the right answer for me? Should I be raising equity? We're getting the same questions from CEOs all the time. And so we started to think, okay, we answer these questions, in the conversation. We should be able to build a platform that provides these CEOs with the kinds of answers that they're looking for without them having to talk to me or to have to talk to Carlos. Because, as much as we like to think we're, unique people, our insights are sort of the same across all these businesses, right? There are just patterns that emerge over time. And so that was the initial thinking was let's try to solve this bigger problem for CEOs. The interesting thing is, though, you're right. We've seen a ton of interest in, hey, can you guys help me? Can you guys help? I'm not a fit for debt, but can you help me in some other way? And so that's really given us the fuel and the excitement to start building out these tools.
Well, it's a different reason to start a conversation, right? You can reach out to other founders and say, hey, no matter what stage you're at, we have these free tools. You should check out our free tools. And then 100%. A certain percentage of them naturally will be a fit for you later, or maybe they can refer you to somebody else, right? Like even if they're not a fit, they know who you are and they say, hey, they're talking to their buddy the next week and like, hey, you should talk to Novel. They do this
exactly.
Thing. It's just a great go-to-market strategy. And I think that's a struggle with almost every company, right? You're always trying to figure out how do I scale sales and marketing, different go-to-market strategies that work. And I think it's a really smart strategy by you guys. So kudos to doing that.
Appreciate that. And you're hitting on something that we talk about also with CEOs all the time is that go-to-market strategy. It changes over time, right? The strategy that you use when you start is necessarily going to change, and it may change drastically as you grow. That's one of the most challenging parts of building a business and then growing it sustainably.
Well, I come more from the product side as a software developer for the last 20, 25 years, right? But I've definitely learned over my career that the most important part of it is actually sales and marketing. And I think it's easy to build the product. Of course, non-software developers think that part is really hard, right. But I think it's relatively easy to build a product. But I think everybody agrees that growing the sales and marketing part of it is a huge challenge. No matter what, it's always a huge challenge.
It is, and it's a skill set that I don't know about you, but it did not come naturally to me. That was a set of tools and frameworks that I had to learn how to sell effectively, and then to learn how to build.
So tell me a little more about who the target user is of this. So is it somebody that's doing $1 million a year in revenue, and they need to raise a couple $100,000? Like what does that usually look like? If I'm listening right now, how do I know, like, oh, I would qualify for this?
Well, you would no matter what. You're qualified. Okay. So we're looking at B2B software and tech-enabled services companies with anywhere from $350K to $20 million in revenue. I know it seems kind of like a big swath there, but in that sort of in that band of company, there's usually something that we can do to help. Now, there are underlying dynamics that we dig into when we start underwriting. And we're really looking at a company's revenue? How predictable is it? How repeatable is it? How comfortable can we be that it's going to look more or less the same or better over the next 24 to 36 months? But if we can get comfortable with those facts, then we can typically provide a check of anywhere from 20 to 40% of a company's revenue.
Okay. And it's a great need that other banks won't do, right? Like
Oh,
that was
100%.
this that was the story that we had back in my Vin Solutions days, like 15
Yeah.
years ago. Is we were making $1 million a month in revenue, but like barely at break even. We're right at that threshold, right? And
Yeah.
we go to the banks don't want to loan us any money because like you don't have any assets to
Yep.
borrow against. Where we would have loved to work with somebody like you, it's like, hey, we just need to hire a couple people. We need to buy some more servers. Like, we can't keep up with growth. Like, we just
Yep.
need $500,000, whatever it is. Like, you would have been a perfect fit for us. But of course, naturally, once we were making like $3 million a month in revenue and making $1 million a month in profit,
Yeah.
everybody wanted to give us money then
Everybody's
when
your
we didn't
friend
need it.
then.
It's like
Yeah.
always the way it works.
It's funny
But
that that's still the case, Matt. I mean, you said that's 15 years ago. That's still the case today.
that was a long time ago.
Banks still don't think about software companies as creditworthy generally, right? Some are willing to take that kind of risk, but at the end of the day, we view software companies that are building recurring revenue streams as very much creditworthy, right? That's an exciting business. It's a business that grows. It's a business model that makes sense. Banks still don't think about it that way. And I don't know when that's going to change, but I've been waiting for it, wondering, are we going to be competing with regular banks? And the answer is no.
You consider yourself a bank?
No, that's offensive to me, actually. Do I look like a banker? This interview's over. Not at all. Banks have to think about, they have depositors and all sorts of things. No, we think of
Okay.
ourselves as pretty scrappy entrepreneurs who take a little bit of credit risk and try to help other entrepreneurs. We're definitely not a bank.
So there's a bunch of different options out there and different models for all this stuff. And I'd love if you could help educate everybody on these different options. Like, you guys are one of the options. There
Yeah.
are other options. Like, one of my friends yesterday messaged me. She's in a cash crunch because something happens and maybe she needs 50 grand or whatever. And she's like, man, before she had talked to Stripe, like Stripe has
Oh
some
yeah.
loan thing that they do. And in the past at Full Scale, we used Loan Builder and Cabbage. They were
Hmm.
like short term,
Yep.
6 to 12 month loans at really
Yep.
high interest rates a long
Yes.
time ago.
Yes.
So I guess talk to me more about some of the other options that are out there and maybe any guidance on when people should use the different things.
Yeah. That's such a complicated question.
You got 1 minute.
So, yes. Counting down, and now the pressure's on. So let's just focus right now just on different kinds of debt products that are out there, right? So what we provide is a 2 to 3 year growth loan. The payback structure is you have a smaller payment in year one, a larger payment in year two, kind of giving you the opportunity to grow into payments. Our experience is that we want to provide a product to entrepreneurs that they can use as they grow, right? We don't want to provide so much. We're really careful about how much we provide because we know that companies have to pay it back, and we don't want to dip into cash flow that can be used for growth with the loan that we're providing. So we're
Okay.
super careful about that. And that, by the way, if you're an entrepreneur and you're out raising money and you're talking to a lender, that should be foremost in your mind. Am I going to be able to pay this money back while still growing my company, or is this going to dip into my cash flow and potentially put me at risk? Which we have seen a bunch of times. We have competitors that are out there, other lenders who will do, kind of like you said, short-term loans. Sometimes they'll size a loan. Listen to me, I sound like a credit guy. They'll
Not
provide.
like a bank all of a sudden.
No, don't say that. They'll size a loan at like 40 to 50% of a company's trailing 12 revenue. So, you got $1 million in revenue, you get 400 or 500K in a loan, tomorrow, and then you got to pay it back in 12 months. That's massive. Those payments are huge. And there's no possible way, unless you're growing at like 150 or 200%, that you're going to be able to A, service that debt, and B, keep your company alive while still trying to grow it, right? Those loans are extremely punitive. They're extremely extractive, and they can put a company at significant risk. We've seen that a bunch of times. We've helped companies out of those bad deals, but sometimes they're so bad we can't even help them out, right? Like there's too much debt there, not enough revenue, we can't help. So those are, that's one extreme. Kind of in between, I think, is what you've talked about, which is Cabbage, and I think you said Loan Builder. Also high interest, very short term compressed loans. Sometimes those things can be great if the interest rate is reasonable and if it's a short term cash crunch, kind of like what you mentioned, right? Like sometimes
Could be
it's like
accounts receivable. Could be accounts receivable
exactly,
problem. Whatever.
exactly. Could be your receivables you're not getting your receivables in fast enough. And in that case, sometimes a short term loan makes sense. In fact, I would say that what we do with our 24 to 36 month loan, that's not a great fit for something that's a short term AR kind of a challenge. We also have a shorter term product that we can use to help solve that problem. But most of
Okay.
our customers are using the growth loan, because that's typically what excuse me, that's typically what we're really good at. That's the challenge that we're really good at solving is how do I grow using capital that's not diluting me as an owner? But but there are other debt products out there too, like venture debt, right? Like everybody always hears you got to go raise venture debt. It's going to be, it's going to be easy. Well, maybe, but you have to have the right VC sponsor, meaning you have to have the right investors. It has to have been, you have to have raised some capital recently, probably within the last 3 to 6 months, in order for a venture debt provider to be able to provide you a loan. And your equity sponsorship, your investors have to be sort of underwritable because they become the backstop for the venture debt lender. So those are, and there are so many different use cases and so many different products out there. What we always talk with entrepreneurs about is what are you trying to do, right? Like, are you trying to figure out how do I grow without diluting myself, without taking on equity? That, I've gotten to the point where I understand my unit economics, I understand my CAC, I understand my LTV. None of those things are really mysterious anymore. So I know if I put $1 into my engine, I'm going to get $3, $4 or out or whatever. Once you have those metrics nailed down, then it makes a lot of sense to take on non-dilutive capital, right? Because there is no risk, there's no equity risk anymore. And when I say equity risk, I mean there's no risk that you should pay equity premiums for, because I'd much rather, as an entrepreneur, pay lowish interest rate for non-dilutive capital to grow a machine that I already know how to run than take on a bunch of equity, which can be asymptotically expensive, right? Like the better you do, the more expensive equity gets. So I've had a lot of coffee, and that was a lot of words, but that's kind of how we think about it. Is let's just start from what are you trying to accomplish, and then let's point you to the product that makes the most sense.
Well, I do want to take a minute to remind you today's episode is brought to you by Fullscale. If you're trying to accomplish building software, definitely check us out at fullscale.io. So you mentioned a bunch of different examples there,
Mhm.
different kinds of debt. Something else I wanted to point out is some of these require a personal guarantee and some of them don't.
Yeah.
So I'm curious, like for what you guys do, does it require a personal guarantee?
No, no, we don't require a personal guarantee at all. We're not a bank after all, Matt, as we've covered. That was a very purposeful choice that Carlos and I made very early on. Like, would I want to take a loan from a company that was offering growth capital and put a personal guarantee out there? I don't know. I wouldn't be super excited about that. So we got really focused on, let's just make sure we get really good at underwriting the business. And if we mess that up, that's on us, but we're not going to come after your house, right? That
Well,
sucks.
when we did this a long time ago with like Loan Builder or whatever,
Hmm.
it felt like mafia money. It felt like it was like super high interest rate.
Yeah,
And I swear, if I remember right, they took payments every week. I think
I'm
we
not
made weekly
surprised.
payments. I
Yeah,
think we made weekly payments. They were super high interest rate, and it felt like mafia money. But for us, it was a short
yeah.
term need. And it was like around COVID or whatever, and
Yep.
it it worked out. But yeah, we had to do a personal guarantee as well. So
Those
I
those short term loans. Sorry to interrupt, Matt, but those short term loans, they typically work that way, right? Like, here's a bunch of money. We as a lender, we're gonna make sure that we take very little risk. So we're gonna scrape as much money
yeah.
out as we can, as quickly as we can. Again, that's tough. Like, I don't want to take that kind of loan. I don't want to put that kind of loan out there. So, you mentioned Stripe earlier. Stripe is so easy for entrepreneurs to use because most entrepreneurs have at least some of their revenue stream running through Stripe's platform, right? You have any idea how much the APR is on Stripe loans? It is
No, what is
not.
it?
It's not cheap. It goes anywhere from like 25 to 40% sometimes if you do the math. It is brutal. So, that money comes in on Stripe. They've taken some kind of a loan. They take a loan from Stripe. Their revenue comes in, and then they'll scrape. Stripe will scrape cash
Yeah,
every single day, every
yeah,
transaction.
yeah.
Um, And that's why it gets expensive. If they were scraping that cash, once a month or something, it would be cheaper. But because they're getting money back so fast, the effective APR is really, really high. So and it's a beautiful machine that Stripe has built. It's a beautiful, beautiful thing that they've done. But on an APR basis, it can be pretty rough.
So I want to talk about something else for a minute. So
Yeah.
what percentage of companies raise VC money? It's only like 5% or 10%. It's like it's not a very big number, right? Like
Oh, it's worse than
the
that. It's
other,
like a quarter of 1%. Yeah.
yeah, whatever the number is. I mean, it depends on if you're talking about friends and family money or
Yeah.
how you categorize all this stuff. But it's a low percentage, right? So we
Yeah.
know whatever the percentages are, 90%, 95%,
Yeah.
99%, whatever the number is, people don't raise big VC money, right? And
Right.
that is your target audience is that other 99%.
Mhm.
And it also feels like in general more and more people aren't raising a lot of money, or if they are raising money, they're doing like one round of financing. They're not doing like multiple rounds of
Yeah.
financing. I mean, do you feel like in general most companies aren't trying to raise as much money? They're trying to be like they're thinking about things differently now?
Yeah, I think ever since sort of the VC winter hit, that started 18 months or 2 years ago, I think entrepreneurs are necessarily thinking about their businesses in a different way. We will provide capital based on your underlying metrics, based on your growth, based on how the business is doing, irrespective of whether you've raised venture money or not. I would actually say probably 35-40% of our portfolio of our customer base has actually raised venture money in the past. Now,
Okay.
whether they will go on to do so again is entirely up to those companies. But what's really interesting is the days of free money are gone, free equity money, right? VCs are not plowing money into everything that they see anymore. And so what that has created is a level of discipline and concern among CEOs, right? I know I can't go out and raise money like I used to. And when I do, if I am able to, it's going to be extraordinarily expensive because valuations are so low. So what's a better plan for me as an entrepreneur? Often that better plan is I'm going to have more discipline. I'm not going to go just like you said. I'm not going to go out and raise a bunch of money, and I'm not going to go out and raise a subsequent round of equity capital. And the money that I do get, I'm going to be very judicious with, and I'm going to get to break even and grow a business that's more sustainable than I would have built, 5 years ago when equity money was plentiful and felt like it was free. I think there's been an enormous shift in the mindset of entrepreneurs, which for us has been great, right? Because that's what we want. We want
Yeah.
to talk to the entrepreneurs who are like, can build a business irrespective of equity capital that's going to be successful for the long run. That's why we're here. That's exactly who we want to work with. So I love the VC winter because it really plays to what it plays to it creates a shift to the mindset that we've always really appreciated the most.
Well, I feel like the more money you raise, the bigger bet that you're making, right? Like if
Oh
I go
yeah.
to you and you say I need $500,000, $1 million, I probably have a really good idea of how I would spend that money, and I'm probably a little more frugal with it. I know exactly
Yep.
what I want to do. A couple key hires, couple, marketing, whatever. But if I
Yep.
go raise like $5 million, $10 million, $20 million, all of a sudden you start doing some crazier things. You're making bigger bets, more risk,
Yep.
and you're betting like, oh, we're gonna make this company worth $100 million, $1 billion, whatever. Like you're making
Exactly.
a much bigger bet, bigger risk, right? And most people don't think about the downside of all of those. And I read about the stories a lot. And actually, it happened to one of the companies here in Kansas City that was actually a customer of ours at full
Mhm.
scale, probably somebody you know. That I think they raised like 10 or $20 million, and then when they exited the company, the founder got nothing
Yeah.
because they had raised enough money that there was all the liquidity preferences and all that, right? So
Yep.
those original investors are getting all their money back, and he ended up with not much of anything except now he works for the company that they acquired him. And so there's so much risk, is my point, in going and taking the big money. Where
Yep.
I'm more of a practical founder. And for those of you who don't know Greg Head, I highly recommend you follow him on LinkedIn, and his podcast and newsletter. It's called Practical Founders, which is more in alignment with that. I'm a huge fan of him. He puts out content every week on about this, but I'm I think we're all in alignment. Like I'd much rather see somebody raise $500,000, $1 million, couple $1 million that they know what to do with in a short
Yep.
term, and they know how to see the ROI in it. Like these I understand there are some people like if you're going to create Uber or something, you're going to need to raise a lot of money. If you were going to build SpaceX and send something to Mars, like, yeah, you're going to have to raise a lot of money. Like, I
Yeah.
understand there are use cases for that, but for the other 99% of the use cases, I think you just don't need it.
I completely agree. Think so this is a topic that we could probably talk about for an hour in and of itself. I think there is real danger in raising too much equity, just as you said. And the reason is, I'm just basically parroting back to you what you've already said, but the more money you raise, the bigger that valuation is. And what you see most often is you are raising capital at a valuation that is a bet that you can achieve the plan on which you are raising that money, right? So I
Which bet?
raise money exactly. I raise money at $100 million valuation, but objectively, I'm only worth 50 million at this moment. I think that happens all the time. I guarantee it happens all the time. And then you've got a $50 million bogey to make up before you're really worth the capital that you've just raised, right? And then if you don't raise that, if you don't grow quickly enough to hit that marker, then you end up just in the situation that the founder that you described. And I can't tell you how many founders I know who have had that exact experience. I raised too much money. I got over my skis in terms of valuation. I finally had to sell my business or get some sort of an acqui-hire done. I got nothing out of it but a job. It's better than nothing, but that's not why most people start a company, right? Most people don't start a company so that they can get a job. So it's one
Well,
of
and
those things
I
you have to be super careful about.
Well, I think that's why you see some of these crazy valuations of OpenAI and Anthropic and some of these.
Mhm.
It's like, oh, the valuation's $10 billion, and
Right.
Amazon invested $1 billion into the company or whatever. But to your point, Amazon is investing at a level where they're going to get their liquidity preference. Like they're almost
Right.
guaranteed to get their money back because they're like, there's no way this company is going to be worth less than 5 billion. So we'll invest 1 billion with this preferred rate of return,
Yeah.
guaranteed rate of return. And so we're at least probably guaranteed to get our million back. Yeah, so the valuation was 10 billion. We don't really care. We know we're going to get an ROI on our billion. If it does really good, that's great. Like I feel like that's the game that they play and that's why the valuations are so high.
Well, I think you're right. And I think there are a couple other dynamics at play too, right? Like Amazon, they don't care, right? It's not interesting to them whether you as a founder walk away with a meaningful chunk of change at the end of the day, right? They just don't care. And I think that's part of the systemic problem that you see in early stage equity investing. It's not necessarily that VCs don't care, but it's less important to them. They're more interested in, am I going to get the right target ownership? Am I going to own as much of the company as I need to for a seed or a pre-seed, seed, lemon seed, mustard seed, and then Series A investment? Am I going to own the amount of the company that I need to own? That's what they're concerned with. They're not really super concerned with, are you as a founder going to walk away with something meaningful if you're so I think that's a systemic problem in the early stage equity markets.
Well, and I feel like it's a little easier to raise this kind of debt financing. And I did it at StackFi. We raised, I
Yeah.
think it was $3 million in similar sort of fashion,
Mhm.
revenue based financing. And I think from the other side, like if I'm in your seat, it feels less risky than being a VC. Like if I'm a VC and I'm getting equity, there's all these different things that could happen. But if I'm
Yeah.
debt, I'm in first position. Like I'm
Mhm.
always in first position because I'm the debt. I mean, is that how you guys feel as well?
Yeah, I mean, we do feel more secure than our friends in the VC world for sure. We do, as part of our structure when we provide capital to a company, we do a UCC1 filing, meaning we have a lien on the assets of the business, but we actually purposely carve out IP. So, if things go sideways, investors and founders, I guess at the end of the day, we have a lien on like tables, chairs, and laptops, which is,
Not worth
not all.
anything.
Yeah, exactly. But our point of view on that is this is the kind of capital that we're not taking equity risk. We're not taking a risk where we would be comfortable with something going to zero, right? If something goes to zero, we've really messed something up. So we try to build, what we've tried to do is create a customer base of entrepreneurs and companies that are gonna they're just going to keep going and going and going and keep growing. So yeah, but as a it is a totally different world. I came from the equity investing world to this, and I will tell you, it is a totally different mindset, it is a totally different language, and a totally different world. And you have to pretty quickly learn, like, well, I can't take risk.
Well, so let me ask you this. I know there's a few different companies that do similar things to what you guys
Mhm.
do. If somebody is thinking about doing this right now, what are some of the things they should look out for? Like, some of them ask for
Yeah.
warrants or they actually ask for equity in some way.
Yeah.
What are the things that people should be looking out for, and like the red flags, like the bad providers of this stuff?
Yeah, I think first and foremost, be really cognizant of the repayment structure, understand exactly how that's going to work. And by that, I mean, am I paying daily, weekly, monthly? If you're not paying monthly, you're probably paying too often. And that's something that you should be paying attention to, because it makes it really tough to manage cash flow when you've got cash coming out of the business at such velocity. So I would pay attention to repayment structure. I would pay very close attention to don't get seduced by a big check. A big check and a short payback structure, a short payback time frame can be really, really problematic for your company and put you at risk. So I'd be very careful about that. All of this kind of gets to cost of capital. You don't want to be paying, exorbitant cost of capital, but that's relative, right? It depends on where you are as a business and a bunch of other stuff. So I'd be very careful about that. I would be looking at the provider and asking people I know, is this somebody that you've worked with? Is this somebody that you've heard good things, bad things about? Understand what happens when something goes sideways. Some things do go sideways, and you want to make sure that you're working with somebody who's going to be, helpful, or at least approach it in a partnership way, not in a punitive way. And then, certainly warrants. Are they going to ask for anything other than, if it's a lender, are they going to ask for anything other than your loan payback and some transaction fees that seem reasonable? If they're looking for warrants, are you comfortable with that? Like, I wouldn't love to give up warrants unless I was getting a whole bunch of money. But you got to really look at all those things, because all of that stuff adds up to how expensive this money is for you and for your business. And warrants in particular, you don't feel it now, but you'll feel it when you get to the point where you're selling the business. All of a sudden, you know, somebody who owns 2% gets a meaningful slug, and you're like, I wish I hadn't done that.
Yeah, you're like I paid 30% interest plus I gave up
Exactly.
2% of my company for this thing.
Exactly. All of a sudden, that doesn't feel painful when you're signing the term sheet and the deal docs. It feels painful when it actually comes to fruition.
Well, I really appreciate having you on the show today and helping educate us about all these alternatives. I've actually used a few of them, over my career, and I'm a huge fan of it. I'm a huge fan of people bootstrapping and being more practical. Getting that couple hundred grand, 500 grand, million, whatever it is when
Yep.
they need it, is definitely the practical way to go. And I'm glad to hear your guys' success here in Kansas City, and I really appreciate having you on the show. And you also host a podcast, right?
I do. I do. It's called the RBFN podcast, stands for Revenue Based Financing Network. We talk about all kinds of stuff related to alternative capital. You're a much better podcast host than I am, but if you're interested in alternative capital and how that market works, it's an interesting listen.
So your guys' website is novelcapital.com. Obviously, you
Yes,
guys do the financing. We won't call you a bank, but you loan people money. But
that's right.
you
That's
you
right.
also have some other tools, right? So who
Yeah.
tell us more about those tools, and maybe if people are listening, like, would it be a good fit for them?
Yeah. One thing I want to jump back to your earlier question. One thing I forgot to say, you said what should you be thinking about if you're out raising, debt capital? Use of funds. Make sure that when you are raising debt capital or a credit facility, make sure that it fits your use of funds. So kind of like we talked earlier, like, don't take a 2-year loan or a 3-year loan or a 5-year loan to solve a 90-day problem. It's not going to
Right.
work. And don't take a 90-day loan to solve a 3-year growth problem. It won't work out. Um, so I forgot that I wanted to say that. But then back to your question about the tools that we've built. So we're releasing a tool that we call Venture Match. And it is a way for entrepreneurs who sign up on our platform to share some data with us, their financials and a couple of other kinds of data. We take that, we match those companies to equity investors who are interested in companies with their underlying dynamics. And then we facilitate introductions based on the data, not just, hey, Keith thinks this is interesting, and so, you should go talk to Matt. So that's a tool that is that we're releasing now. It's very cool. It sort of automates and creates a way of making introductions in a world that used to be, it has to be sort of the good old boy network, and it has to be a warm introduction. We're kind of trying to apply a different approach, which is we have a bunch of data. We understand a lot of things about the companies. Trust us. Let's help them find the right kind of capital if we're not the right kind of capital for them in this moment. And that's any company. I mean, any company, pre-seed and beyond, who's looking for qualified introductions and data-driven introductions to good firms, good VC firms, we can help.
Awesome. Well, I really appreciate having you on the show today. Once again, today's episode is brought to you by Fullscale. If you need to hire front-end, back-end, mobile, QA development, whatever kind of talent you need help with, you can check us out at fullscale.io. If you're not subscribed to our newsletter, definitely go to startuphustlenews.com. 30,000 people are subscribed to my newsletter, which is pretty cool. So sign up for that. And once again, this is Keith Harrington, co-founder and COO of novelcapital.com. Keith, thank you so much for being on the show today.
Absolutely, Matt. Thank you so much. This was a lot of fun, and I appreciate the time.
All right. Thank you, sir.